Hi, my name's Stuart Weems, and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get in today's Q&A episode. And the first question is from Nick. Nick's been investing in ETFs for the last 6 years using Self-Wealth and Perla accounts in our individual names. Current portfolios are linked to obviously a relatively cost-effective or even free version. And the idea was to start paying for a premium version when they start selling, or if they start selling ETFs, so then they can track CGT. At the moment, both portfolios are around, there's two portfolios around 130,000, and one of them is geared against our home. So I imagine that's $260,000 worth of shares. With the current tax changes, I'm wondering whether we should simply continue with our current setup or whether it makes sense to start a fresh new brokerage account and separate share site tracking for cleaner record keeping. I'm also curious about whether a family trust is worthwhile setting up for our situation. I know you can't give personal advice, but love to hear you talk generally about what factors people should consider. Okay, so just for those that don't know, ShareSite is something that overlays a portfolio on an online broker and then can give you some tracking. Pretty important tracking around taxable income, although a lot of that comes through data feeds directly from the ATO. Also, cost-based tracking as well as performance. And, performance is a pretty important thing to track, I would have thought. And the cost is about $120 a year or something in that vicinity. It's not huge. And look, you can't manage what you don't measure. So I think putting aside, and I know this is Nick's question, is really around capital gains tax and so forth. Putting that aside, I think performance management is worth at least $120 a year. 100%. I mean, don't you want to know how well your portfolio is doing, which parts of the portfolio perform well and which parts didn't perform so well? Now, I know you can go to ETF websites and so forth, but in the short term, timing will have an impact on performance. So when you entered the market, if you traded, these sorts of things. Now, if you overlay on top of that the taxation reporting and cost-based reporting, I think it's worthwhile. I think I would pay for ShareSite or something along those lines. So let me put it differently. I think I'd pay $120 almost for any portfolio size, almost. I mean, if it wasn't, if it's just a couple of ETFs and it wasn't a huge amount, you probably don't need it. But the alternative is that you can reconstruct a cost base, and we've had to do this for some client portfolios, logging into the share registry, and it'll tell you, how many units that you purchased and units allocated through dividend reinvestment plans and so forth. So in terms of reconstructing a cost base, it's not impossible. And I think with AI today, you could probably automate it quite a bit. But I think the performance element is the compelling argument here. So really anyone that runs a ETF portfolio, I think that's really useful information. In terms of a family trust, well, I'd hold fire on that at the moment, obviously given the proposed changes to taxation of family trusts. And when that legislation is finally enacted, if it's finally enacted, of course, I'll do an episode on it and talk around, what are we doing internally with our clients to sort of navigate these changes. And we've already got a couple of ideas in terms of what we'll do to do that. So for now, no, I just leave it in personal names, but it really comes down to the size of the portfolio, because that's really going to determine the amount of taxable income that the portfolio produces from year to year, as well as the potential capital gains and how much flexibility you might want to have in respect to those taxation elements. So, if I expect a portfolio is going to get to about $1 million within the next 10 years, I'd be inclined to have some taxation flexibility on what I'm going to do with those taxable elements over time. The other thing too, it's kind of interesting. We talk about it a lot. I mean, I talk about constructing an ETF portfolio to reduce taxation drag. So that is invest in parts of the market, particularly global equities, that don't pay as much dividends. But there's some ETFs, we're just having a discussion about it today internally, some value ETFs that paid very high dividends, about sort of 15%. and even emerging market ones as well, which isn't a terrible outcome. I mean, I think one of those value ETFs delivered like a 50% return last financial year, and 15% of that return was in income. So yes, not so great, but you still got a 35% uplift in value. I guess what I'm sort of saying here is you can go to a reasonable extent to design a portfolio so that you reduce the taxation drag, but sometimes these things happen. I remember when Vanguard didn't have what's called a TOFA election, which is a taxation election to do with hedging, when it didn't have it on its international index fund, it delivered a very high level of distributions. I think it was 2 or 3 years ago, maybe even 4 years ago, and it paid out something like 7 to 10% in terms of returns. So again, these things happen from time to time. And so it's important that we track these things. What is your portfolio return? How much income? How much growth? What are the tax nature of it? Which parts performed and underperformed? And again, at the end of the day, what you're trying to do is hold yourself accountable, because the alternate, instead of building an ETF portfolio, is make additional super contributions, putting aside the fact that it's trapped inside super. So, you want to make sure that whatever decisions you're making outside of super are just as good as the decisions that you wouldn't have to make inside super, because obviously your super fund does it. So I think, Nick, that performance tracking would be the reason why I would go to ShareSite, and the added benefit is the taxation tracking. Also, I should say that when we look at a portfolio and we want to reduce exposure, often we think about capital gains tax, and you can nominate which parcels you're selling. So, it's possible in some scenarios where we look at reducing exposure for a client, either because of concentration risk or we think something is overvalued, we can sell a certain amount of the holdings and maybe not crystallize too much in capital gains tax because a particular parcel maybe was bought at a higher cost. So you want to have, that flexibility around portfolio management moving forward, and information is power. So overwhelming yes to using ShareSite, and in terms of trust, just hold fire maybe for now. Okay, next question is from Matt. And I should say I'm getting these questions now mid-May, so these are sort of post-budget changes. So Matt writes, avid listener of the pod, one of the first things that came to mind with the new CGT regime being minimum 30% and maybe higher effective rate of capital gains tax with indexation was the strategy that you outlined in episode 350 about buying a property in a company and borrowing personally to buy the shares so that the gearing is in your personal name. Because in your analysis, you compared this to an effective CG2 rate of 23.5% under the old rules, the advantage was even material back then. Might be worth another discussion on the pod. So, Matt, it's a good point. Just to recap for those people that don't remember the episode, what I was talking about was the downside to selling an unlisted lumpy asset like property is that you can't spread the capital gains tax liability over many tax years, like you can obviously with an ETF portfolio. So one of the answers or responses to that could be crystallize that capital gain in a company. Sure, under the old rules, you couldn't get the 50% discount, but the benefit of using a company is you always get a credit for the tax paid, and then pay out a dividend over the next 15 years. So essentially, crystallize the capital gain in a company, pay your 30% tax upfront, but then drip feed that profit, that taxable profit out over, say, a 15-year period. And if you do that, I think I concluded that the average or effective tax rate was around 15%, which was better, even taking account the time value of money, better than doing it in your personal name. And another way to preserve the negative gearing benefit would be to buy shares in that company, and the company uses the money that it's raised from selling new shares to go and buy property. So for instance, I go and borrow $1 million against equity and other assets. I buy 1 million shares at $1 each. The company issues 1 million shares at $1 each to me. So it has $1 million of cash, the cash it raised through issuing shares in the actual company. It uses that $1 million to go and buy the property. Meanwhile, I've got a loan for $1 million, which I use to buy shares. And the argument, if you go and have a look at the legislation, there's nothing in the legislation that says that that wouldn't be tax deductible, because it's not related to rental income. That interest deduction is related to buying shares in a investment company, and that investment company will pay you a dividend, which essentially will be the net rental income. But the nature of the income will be dividend income, not rental income. And for those reasons, it won't be caught by the new legislation. However, we do have to deal with what's called Part 4A, which is the anti-avoidance provision in the Tax Act, which says that if I do something predominantly to obtain a tax benefit, then that's considered tax avoidance. And so to make sure that you don't fall foul of that provision, you need to have a commercial reason for doing something other than to obtain a tax benefit. We internally couldn't think of any reason why you might want to structure a investment property in that way. So really the only reason left over is really a tax benefit. And then we also thought that if people start doing this, the ATO is not going to like it. And then the ATO is just going to knock it on the head. They're going to come back and say, no, we think that's anti-avoidance. We think it's a high compliance risk. We don't like it. Or even worse, the government will just legislate against it. So yes, it could have worked in the old system, but we think it's probably too aggressive given the current change in legislation. Having said that, there are some circumstances where you could use a company style arrangement, and typically those circumstances, or at least I don't want to, none of this is personal advice or tax advice, of course, but there's some scenarios where if a investor has a lot of cash, they might decide to invest that cash in property first, and because then they've invested all their cash and they want to go and introduce an ETF portfolio, so introduce some share exposure, they would then need to go and borrow for the shares. So there are some circumstances where we can plan around it, and using a company style arrangement could still work, but it's the order in which we invest in. I can't really say much more than that, because if you start talking about the legislation's drafted is if you start talking about a particular tax scenario as a way of trying to sell it as a strategy, you could be accused of running a scheme, believe it or not, and that scheme is a tax avoidance scheme. So of course I don't want to do that, and I'm never going to do that, but there are some scenarios at the margins that you could potentially utilize. I think it comes back to having good strategic advice, and also I think there's got a really good balance between sticking within the black letter of the law but making sure you make the most of your opportunities. And I think there will be, and just be careful, every time there's a change, and pretty substantial change, some lawyer or accountant or both or planner think up some what might seem like a really smart solution to get around the problem. The issue, though, in almost all circumstances that I've seen in the past almost 30 years of being in financial services, is that they certainly serve the advisor, but they don't serve the end client. Because what happens is the advisor sells this smart solution. The client feels really smart, like, I've found a way, I'm better than the average bear. I've found a way around these rules, pay hefty fees going in to get that solution. And then all the ATU has to do is turn around and go, no, we don't like it, put out a practice statement, or the government changed the legislation. And then the poor client's got to go back to those advisors or other advisors to unwind it again. And so just be smart with strategy and tax strategies and these sorts of things, but just be mindful that there probably will be a cohort of, in inverted commas, professional advisors that might go and sell what seemingly seems like sexy solutions to this terrible tax problem. So Matt, thanks for listening to the podcast, and thanks for remembering even about that particular episode. But unfortunately, at least at this stage, we don't think it's the right way to go. Having said all that, tomorrow and next week, I've got some interesting analysis and thoughts to share with you with respect to investing in established property. So over time, we'll work through this together, I'm pretty sure. Okay, next question is from Michael. Under this new budget, even though the existing purchases will not be eligible for upfront negative gearing, if we debt recycle 150 to 200,000 through our PPO mortgage for a deposit for a new investment property, would that amount still be eligible to claim interest as the funds we use for investment purposes? And the remaining debt on the new investment property will obviously now not have upfront negative gearing benefits. No, Michael, if you do the debt recycling, and so debt recycling obviously is just repay the home loan, frees up equity against the property, reborrow those funds, not redraw, reborrow from a separate account, of course. Very important around loan structuring. It won't be, because the purpose determines determines deductibility. Okay, so the purpose will have a direct link with earning rental property income, and any deductions related to rental property or rental property losses, more correctly, have to be carried forward if that established property was purchased after budget night. So no way around it in terms of, I guess, shuffling debt around from that perspective, unfortunately. It's really good. I started to get these questions from budget. I imagine there was going to be heaps, and there are actually a lot of questions received in May, but look forward to getting through and workshopping them, because who knows, we might find some good ideas in them. Okay, next question is from M. M writes, my question relates to purchasing a property with our daughter, who's 25, post-uni, just entering regular work. She has shares gifted from her grandparents for worth around $40,000, and she's just about to enter regular working life. We have a property to sell, which she's been living in almost rent-free while she's been at university. The loan is $230,000, owned 50-50 with the husband, in an excellent suburb of WA. Value is approximately $900,000. The purchase price was $235,000, so obviously lots of equity in that property. We are currently considering selling that two-bedroom townhouse and buying a one-bedroom apartment nearby, with our daughter joining us as tenants in common, 1/3 each. So obviously 1/3 by the wife, 1/3 by the husband, 1/3 by the daughter. Our residential home loan balance is $215,000. We'd like to pay down as much as possible and also allow the capital gains tax to be transferred to our superannuation, as I understand this is possible. I'm 59 with 38,000 in super, and my partner's 54 with 138,000 in super. Thanks for your time, and thanks for having such an easy to listen and understand format. Okay, thanks, Em. Okay, so the first thing is, I always tell my clients, look after yourself first as a priority before going and helping children. And if you do that, you put yourself in the strongest financial position that when the time is right, you can help your children down the track. If you don't prioritize your own personal financial situation early enough, you could become a financial burden on your children in the future, which is not ideal. Well, I mean, it's up to you, but it's not something that I'm looking forward to doing. So, I mean, the first and foremost is you've got to, when you're in this situation, you've got to ask yourself, are we in the position to help our child? I know we all want to, but we do have to be selfish to some extent and make sure our financial position is robust and strong as possible, as I said, because you don't do that, you might end up being a burden on your kids later on. And that's going to be an awkward position. So if you've got this investment property that has nearly 650, 670 of equity in it and some reasonable capital gains. So let's talk about the capital gains first. No, you can't transfer it into your super. You can most likely make carried forward concessional contributions. And if M has $38,000 in super, I'm tipping over the last 5 years, M probably hasn't made a lot of concessional contributions. So M can bring forward 5 years, and so can her partner, and bring forward 5 years of contributions and to offset the capital gains tax. So, which is a deduction that offsets the capital gains tax, not moving the capital gains tax or transferring into super. I guess that's a terminology thing, right? But I don't mean to pick on him, but just sort of clarifying that. So yes, depending on your situation, it could be a way of minimizing capital gains tax. And that would make sense, by the way, because you've got relatively low super balances for your age. And so moving that equity into super doesn't sound like a bad idea. Now, of course, you've got to think about opportunity cost. So what will that townhouse do over the next 5 years in terms of capital growth? I'll put that aside just as it's something to consider. But then if you're putting inside super and super does well, particularly from on an after-tax basis, that seems like a good idea. In terms of helping kids, and that's what I'm saying, in terms of prioritizing yourself before, helping kids, the first thing I'd be thinking about is, I don't know what other assets you have, but is borrowing to buy another investment property when you're 59, your partner's 54, the wise thing to do? Is it the wise thing to do even post the budget? So again, I'm recording lots of episodes about that and navigating that, but that would be the first decision. The second thing is, parents co-owning property is a pain in the neck. Look, it might seem on paper to be a really good strategy, but it is a pain in the neck. At some point, parents are going to have to come off title, especially when they become self-funded retirees, or even worse, retirees that are reliant on social security. That starts to become a real problem for the child, because the parents are on title of the property. They have to be party to the loan. they've got joint and severable liability, and so does the child. So if you go to the bank saying, I want to increase my loan or change my loan, and you have someone, that's a pensioner on Social Security, you're going to have challenges around getting that loan approved because the bank doesn't want to end up in court or, end up on a current affair, even worse, having to sell a pensioner's home. That's just a massive red flag for the bank. Also down the track, which also means down the track, parents have to come off title. So how does that happen? What does that look like? You're going to have to pay stamp duty, or if you transfer the rest of the asset to the daughter, you're going to have to pay stamp duty, you're going to have to pay capital gains tax. It's not ideal. Also, the final thought is, what are you teaching your child? You're teaching your child to invest or borrow more than you can afford. Okay, yes, it's co-ownership, but you're trying to help them into the market. Look, we all started out, and I know, property's always been expensive 20 or 30 years ago compared to today. It's always been difficult. And it is just a bit of a rite of passage to some extent to go out and start working, save a deposit, demonstrate that you've got good capacity and to save and cash flow management, and then and only then go and buy an asset. So if she's just finished uni, she's 25, let her get into the workforce, find her feet, understand that whatever career path she's chosen is something that she's really happy to do and stick to. Let her then form some good cash flow management habits, some saving habits. And when she then feels like she's got enough surplus cash flow to be able to fund a mortgage, well, you might be able to help through a deposit guarantee. So that gets around the loan to value ratio. Of course, you can use the government guarantee as well, which is available to everyone. But, whatever you want to do, that's probably the best way you can help her. And what you're doing is saying, look, get your income right first, then get your cash flow management right, and then and only then go and borrow at an affordable level relative to your income. And they are very good lessons to learn as someone that's just starting out, because if you can't get past the cash flow hurdle, the cash flow management hurdle, then arguably you shouldn't be buying property, frankly. And, you've really got to nail that one first before you go and do anything. The challenge with helping a 25-year-old is what happens if the career she's trained for at university she doesn't like, or she wants to have a complete change, or she wants to go back to uni, or doing those sorts. It's just not necessarily the right time, age and stage for a large financial commitment. And by you being on the loan and on the property, it just creates too much complexity and potential cost down the track. So look, I would caution you from doing what you said you're going to do. I would prioritize your own financial position first and foremost, and make the decision that is best for you for the reasons that I stated, and then just help your child in terms of steering them in the right direction of what they need to do in the right order, in terms of find good, stable employment, work on your career and your capacity, invest in yourself and your capacity to earn an income, and then make sure you hang on to as much of that income as possible. And then if she's been able to do that for 1 to 2 years, that could be a good signal that she's ready to go and buy property. Anyway, thanks, Em. Thanks for listening to the podcast. Thanks for your question. I hope that helps. Okay, next question is from Danny. Huge fan of the show. Your Q&A episodes are some of the most practical financial content in Australia. Thank you so much for all you do. Thanks, Danny, and thanks so much for your feedback. These Q&A episodes, an idea that germinated maybe a year or two ago, has really turned into something that I enjoy just as much, as I hope, as you enjoy listening to. And it really is a big savior, because if I wanted to record 2 episodes a week, I'd have to come up with some content like I do every Wednesday, which is always a challenge. But I love the questions because there's always a lot of nuance. And, I think there's some value in answering them, because I might have 10 questions that are just slightly a little bit different, each of them, but the theme is common. And I think by answering them and talking through my approach, I think what it does do is it allows listeners to understand where that nuance is much better than what I could do or impart upon on a normal Wednesday episode. So I'm getting a lot out of them. So thanks very much. And keep sending the questions in, please. Of course, we get plenty, but it's always good to have plenty there in reserve. Okay, Danny writes, I'm 39, my wife's 37. I earn 120. She earns 140 part-time. Following the birth of our baby, we recently relocated from Canberra to Perth. That's a big change. And changed careers. And as a result, our combined income has decreased. We don't expect it to increase in the future. We're currently renting in Perth from a family for $700 a week, and total living costs are about $1,500 a week. We have 2 primary goals: to purchase a home for $2.5 million and to retire retire in 10 years' time with a perpetual income of, say, $200,000 a year. Our current portfolio is entirely Canberra-based freestanding property. So there's a dual occupancy worth about 1.5 with 450 of debt. There's a property in the wife's name worth 900 with 700,000 of debt. There's 4 properties in a family trust, total value 4.3 million with 800,000 of debt, so a lot of money in the family trust. ETF portfolio, 50% VVLU and 50% VGS. 670, so the VVLU would have done pretty well last year. Combined super, and actually, by the way, VLUE, which is kind of a complementary one to VVLU, another value-based, but that one's run by VanEck, did 50% last year, so it's pretty amazing. I've been talking on the podcast a little bit over the last 5 years about how undervalued value is relative to growth. And, actually, if you go on the website, there would be probably, I would expect there's going to be 4 or 5 blogs about it over the last 8 years, maybe. And it's good to see that rotation's coming through and that trend's coming through. Anyway, net rental income's about $150,000, $160,000 per year. That obviously doesn't include, I don't know if that includes debt, but unused credit facilities, about 1.4 million. So got a lot of borrowing capacity. So really in their situation, they've got, if I summarize it, they've got about 1.5 million, just shy, in equity outside of a family trust, and then 3.5 million of equity in a family trust, as well as actually plus the ETF portfolio. So they've got more than 4 million of equity in a family trust environment. Now, they say the ETFs yield approximately 3 to 4% per year. So they're aware of the negative cash flow impact of borrowing to invest in ETFs. So that is, of course, that, they might pay 6% in terms of interest, but they're only getting 3 to 4%. So they definitely need capital growth. Our plan is to invest $1 million from the unused borrowing facilities in the family trust in an ETF portfolio to grow a deposit for our primary place of residence. We're holding off selling the dual occupancy until we can subdivide it to manufacture equity given the flat Canberra market. Are we approaching this correctly? Can we realistically achieve both a $2.5 million primary place of residence and a $200,000 perpetual portfolio without dismantling our existing portfolio? All properties and ETFs are currently eligible for the 50% CGT discount. Okay, so Danny, you've got too much money in the trust to not dismantle the current portfolio, most likely. Okay, so let me just share some thoughts in no particular order, and probably should sit back and really think carefully about it and give you in a logical order. But I just calculated that net equity in personal names is just under 1.3 million, and assuming based on what Danny said, there's no capital gains tax. So we've got about 1.3 million. We really need 2 in personal names. And remember, the reason I'm thinking about this is because we need to pay for the home. We don't want any debt, and we need to pay it from after-tax dollars in our personal name. So if we take money out of a trust or we sell something, it'll trigger capital gains tax. I'm assuming there's quite a bit of capital gains tax in the 4 properties in the family trust and maybe in the ETF portfolio as well. The first thing Danny's talking about is gearing inside the trust. I probably wouldn't do that because I'm going to assume that you and your wife, you haven't talked about kids, like whether you've got other beneficiaries. So who else can the trust distribute to other than you and your spouse, Danny? That's the key question. I'm going to assume the answer is no one. But if you have retiree parents or, a family member on a very low tax bracket that you can distribute to, then of course, this doesn't really apply. But I would be thinking about moving the negative gearing in your personal name. So yes, use the facility that the trust has and maybe you go and borrow $1 million, but why doesn't the trust on lend that to you in your personal name, and you and your wife, because you're relatively similar tax brackets, you and your wife go and borrow, you each use $500,000 of that and go and invest in ETFs. At least then you've got the negative gearing in your name, and try and skew the portfolio so you can maximize the negative gearing benefit. And then also you're going to need the equity in your personal name as well, because you need to pay for this $2.5 million home, I should say. But will that get you there in 10 years' time? Probably not. I suspect you've got 4 properties in the family trust. The other thing is that will the Perth market kind of run away from you? That's what you got to think, like how fast can you save and invest and how quickly will the Perth property market increase as well. And the subdivision thing is kind of interesting in terms of your thoughts there. I would probably get the DA for the subdivision and then test the market to see if you can sell it, particularly with the new rules in terms of new build properties. If there's an existing dwelling that's going to remain on that property, of course, that won't get the negative gearing. But if it's one of those situations where it's an old house, they'll demolish and rebuild, then it will get the negative gearing benefit. And maybe then you find a developer that's interested in doing something like that. Of course, you probably want to wait for a more buoyant market, but at least you have that DA. I mean, you've got to do the research to make sure you're not going to waste your money and that it's easy to kind of refresh that DA and it doesn't go stale. I don't know the rules in that location, like in terms of Canberra, but I'd investigate that. Look, I'd be inclined to take an each way bet. I'd be inclined to borrow some money. I'd try and buy that Perth primary residence within the next, let's say, 3 to 4 years, because I don't think I'd want to wait 10. I'm not suggesting you're saying that, by the way. And look, you might need to sell the property in Queensland in a softer market, but don't forget you'll be buying in Perth in a softer market. So that would be my main concern in your strategy is like the longer I wait to buy the Perth property, will it cost me more? I'm not saying it will, but that's the consideration. If you're going to do some gearing to supplement the deposit and so forth, do that in personal name. But regardless of order, I'd imagine if you sold both properties in your personal name, did some gearing in your personal name over the next 10 years, and maybe sold one of the properties in the family trust, that would, I would imagine, at a guess, put you in a position that would generate $2.5 million of capital to be able to own your family home outright. It's just a sequence consideration in terms of when do you make those moves. I don't think I'd wait 10 years, but you don't have to do it in the next year either. And then will you have enough money even after you've done that for a perpetual portfolio? Look, based on the numbers, I suspect so. I suspect you're comfortably there, but it just depends on how well the remaining 3 properties in the family trust, if we assume we're going to sell one, how well they grow over time. But even with modest growth, I think you're still probably going to be okay. But the biggest thing that stands out to me is the gearing. If you're going to do more gearing into the share market to supplement the ability to buy a family home, do it in your personal name, most likely, not advice, just information. And then just think really carefully about, when you want to do that trade, because I think you can create value by getting a DA. It does take time and you can then sell it to a developer with the DA there. And again, as long as you're selling in a soft market and buying in a soft market, don't forget what you're buying costs more than what you're selling in Canberra. So a 5% increase in Perth is going to cost you more than a 5% increase in Canberra. So don't be too worried about potentially selling in a softer market and doing that transaction, because as we're seeing, the Perth property market was going gangbusters. Now, if that happens again and property sentiment turns around, a 10% rise costs you another $250,000 after tax. So that's what I'm sort of thinking about in terms of the importance and the sequence of these sorts of events. Anyway, thanks for your question, Danny, and all the best with it. Final question. I know I'm a bit over time today, but final question from Daniel. I'm wondering if you can explain the rules around accessing super at preservation age and working, not working. Specifically, what are the exact definitions or requirements around work? I'm in my late 40s, but just thinking ahead, I'd like the option to access super when I'm 60, but may want to continue working at a reduced time. I'm currently self-employed, but imagine it would benefit the wider community if you spoke to all scenarios, including PAYG. Does it matter if you still have a younger spouse that's still working, or is that irrelevant? How does TTR fit into the picture? Okay, so super access rules are if you are permanently retired from the workforce, you can access super from 60 onwards, or you can access super from 65 regardless of whether you're working or not. So you have to be, and you've got to have a full intention to permanently retire from the workforce. That is, you've got no intention whatsoever to go back to work. But there's nothing stopping you from changing your mind. So you can literally permanently retire from the workforce on Friday, convert your super into pension phase, and then on Monday or Tuesday go back to work. And there's nothing that upsets that. Your account still stays in pension phase. You can then create another second accumulation account to make additional contributions contributions into. If you go back and be employed again, of course, then you're going to get SG contributions, and that's completely fine. A little bit easier if you've got a self-managed super fund or if you're self-employed, because it's really just, you sign a declaration, you sign a minute, and off you go, you're done. And you literally don't even need to really stop work, if you like. If you've got a current employment arrangement, well, then you need to cease that employment arrangement. So you might have a conversation with that employer, say, I'm going to resign today, and then I'm going to take 2 weeks kind of leave, if you like, and in 2 weeks' time, I'm going to come back and work for you again. That's fine. There's actually no compliance arrangements around this. It's a bit of a loophole. And rightly so, right? We don't want to lock people out of the workforce. I mean, I don't think, when I say we, I'm not the government, but I don't think we want legislation that locks people out of the workforce. I think we want to give people flexibility around this. A transition to retirement pension is a little bit different because your super doesn't really into pension phase. A transition to retirement pension is for people between age 60 and 65 that haven't stopped work, that want to access some super. They can access as little as they like, but up to 10%. They can take 10%, but they don't get the tax benefit of converting your super into pension as in tax-free. Super balance is still taxed as it was. So that would suit you, Daniel, if you couldn't manipulate your employment arrangements so that you could start accessing your super. So if you can't do that for whatever reason, then a TTR pension's going to be the best way to still get access to super, reduce working hours, and still do work some and take some from super in terms of funding living expenses. But typically, what probably is the best approach is resign from your employer, start a pension, go back to that employer, ask for your job back. Literally could be the next day or a couple of weeks later, and you've got then full control over how much money you can take from super. Your super then transfers to genuine pension phase, which means that if it's under transfer balance cap, which is less than 2.1 million, you're not going to pay any tax. It doesn't matter what your spouse does. This is on an individual superannuation member basis. This decision, it doesn't matter how old your spouse is, whether they keep working, what they do. It's very much on an independent basis. And it doesn't also matter whether you're self-employed or PAYG. Just, I guess, in terms of the mechanics of implementing the strategy can be easier, of course, if you're self-employed, but it really doesn't matter. Anyway, way over time today. Apologies for that. Daniel, I hope that answers your question. Tomorrow I've got a really, I was going to say a really interesting piece. I think it is around, I started writing and preparing for the episode around the idea, does grandfathering of negative gearing justify hanging onto a property? And what I was really thinking about there is, in particular, investors that have invested in Melbourne property and have been disappointed by the returns. And now they've got a unique asset, because if they go and sell and rebuy, they're not going to get negative gearing again. So to what extent do I hang on to that property? So it started from a negative gearing argument, but as I got deeper into the preparation, you'll see tomorrow, I think I've highlighted an even maybe more valuable or interesting point. So we'll get into that tomorrow, and apologies for length of today's podcast, but until then, bye for now. Okay, before I wrap up, just one favour to ask. If you got something out of today's episode, the best way to support the show is to leave a rating on Apple or Spotify or wherever you're listening. A couple of ways that I can help you in return. If you want to submit a question to the show, the email is in the show note. Also, we've got 3 downloadable guides, which you can download off our website. One's a very detailed report on how to choose the best super fund. We've got a debt recycling starter guide, and we've also got a decision tool to help you navigate the tax changes. And finally, if you haven't already grabbed a copy of my new book, Wealth by Design, it's out now, and it's got a very useful AI companion tool with it. Anyway, I'll leave it there, and thanks for listening. Until next time, bye for now.